and welcome to our training today. Today we're talking about bridge loans. We're talking about loans that bridge the gap between getting long-term low interest rate financing that takes a long time to get qualified for and getting the money you actually need right now, right? There's got to be a way in between to get the money you need right now, even if you're high risk in some categories, even when you can't get to kind of bridge the gap to the actual longer term lower interest rate funding. And we're going to talk about exactly how to do that today. So let's dive in. So we talk about business funding. Of course, a lot of businesses need cash, especially right now, because things are unpredictable, especially with the election happening. We don't know how everything is going to turn out, and we don't know if we're going to have a shutdown, if we're not, etc. So having access to money is obviously one of the most important things for any business, even nonprofits, because again, when we look at business failure, the two biggest reasons for biggest failure is mistakes made by us, the entrepreneur, the owner, and lack of access to capital. And to me, both of them can be fixed by money. If you look at Twitter, I think they have 115 years or something that they can continue to lose money before they actually have to shut their doors, right? The rest of us aren't like that. So when we have more money, we can afford to make more mistakes as entrepreneurs. And so I look at the both reasons that businesses typically fail can be overcome by just accessing the cash that you need. So, and of course, as you know, especially with COVID, cash flow isn't always guaranteed. Many businesses have uneven cash flow or unpredictable cash flow, or seasonal businesses or lean times when you don't have access to the money you need. Startups are still kind of getting your bearing. You're not even sure what kind of money you're going to bring in. You're still trying to figure out the difference between your income and your expenses and how to actually make means work. And then again, seasonal businesses that have ups and downs, especially this time of year. Some businesses are taking off. E-commerce businesses will crush it this time of year, while many other businesses are not going to crush it. A lot of other businesses, for example, down here in Florida, when it comes to scuba diving and things on the beach and water, we're getting into the down season there. So a lot of unpredictability, which is one of the reasons that you really need to access the money you need before you typically need it. And I want to touch upon that too, because I can tell you it's really hard to get money when you actually need it, because lenders see that you're desperate. They see that you're in a place where you actually need that money. Your revenue's declining. You're already having a slow month. They would much rather give you money when you're not having a slow month or things are going well, because it shows that you planned ahead. So it's another reason that you really want to get business funding set up. So no matter what's happening to your cash flow, again, all of your bills in the business still need to be paid. Still, seasonal businesses still be able to have to pay those regular things, even during COVID. A lot of places are still having to pay rent. You've got to still pay the expenses, even when the government's required that you actually have your doors shut or be at a reduced capacity. Those bills aren't at a reduced capacity in a lot of cases, right? Startups need to get their inventory ramped up. A lot of e-commerce businesses to get inventory ramped up, and none of that's free. This is one of the many of the reasons that we really look to get capital for a business to overcome all of these obstacles. So one solution is bridge loans, to basically fill that gap. Also known as interim financing, gap financing, or also sometimes you'll refer to what we're going to talk about today as swing loans. These loans basically bridge the gap during times when financing is needed but not yet available. So there's a lot of different kind of funding that can fit in this category. But just think of it like this. You've got the kind of financing that we all want to get. Let's say it's an SBA loan for 30 years at a low interest rate, 4, 5, 6, 7, 8%. Right, that's what we want. And then there's the money that we can get right now to bridge the gap until we can get that. Maybe we don't qualify for the SBA loan. Maybe the SBA loan takes 6 months to get. Whatever it may be, bridge financing really helps us bridge the gap between getting the kind of long-term low interest rate financing we really want and where we are now. It helps us bridge the gap to get the money we need to carry us over until we can actually get the longer-term lower interest rate financing. So both corporations and individuals use these kind of loans. We see them on the residential side a lot, used for real estate. We see them used in the commercial space, in the business owner side, for real estate as well as many other things. And lenders can customize these loans for many different situations. And that's one of the reasons it can work so well for you, is because this can actually come in and be customized to you to fit the need you need to get whatever it is that you need. So for example, you might get a commercial building. You might want to buy a commercial building, but you've got to jump through a bunch of hoops to get the SBA 504 loan. Well, you could use this to fill the gap and get the financing you need until you get the SBA loan. You could use this kind of financing to fill the gap of you getting the financing you need to buy a business. So let's say you want to buy a business and you need the assets of the business in order to actually do everything. Well, you could use bridge financing to get the money you need to be able to give the seller some cash take ownership of the business, then use the business to actually get the rest of the money that you need to finish the transaction. You might be able to get this kind of financing just to get you through a downturn in business from COVID. It might be a seasonal business. A lot of different places you're going to need to fill the gaps that this could actually come in and help. So what is a bridge loan? Well, bridge loan is a short-term loan. Okay, that's again why it's bridge financing. It's short-term. It's money that you're going to get in the short-term interim until you can get the longer-term solution. And it's used until, again, a person or a company secures permanent financing. It allows the user to meet current obligations by providing immediate cash, again, while you're waiting for the longer-term cash. So it's a short-term way to get the money you need while you're waiting for the longer-term way. And they typically have higher interest rates, but that's typically okay because you're not going to pay a tremendous amount of interest because, again, the financing term is so short. So because the term is short, then they're going to charge you more interest because they have a reduced time period to be able to make their money, right? Sometimes it's months. If you're using bridge financing to buy and flip residential real estate, what's called fix and flip financing, the financing is only 6 months long. Other kind of financing can only be for commercial real estate, might be 2 or 3 years. So they don't have a lot of time to be able to make their money. That's why they typically charge a little bit higher interest. And they're often backed by some form of collateral, like real estate inventory. But there's other ways you can get this even if you have no assets or collateral. But bridge financing is most familiar in the areas of asset-based lending. It's most common, especially used with real estate, both on the consumer residential side and on the commercial side when you're buying commercial buildings. So if a company is doing a round of equity financing, it may be expected to close in 6 months. And again, this is a really good solution as well. So this is also called mezzanine financing in the venture capital space. And mezzanine financing is basically where you got a round of money from a private investor. You're in between waiting for the next round of money from a private investor. Mezzanine financing kind of fills the gap between those two while you're waiting for that next round of funding. So if you're getting money from private investors, from angel investors, from venture capitalists, that kind of gets actually issued as you reach different stages in your business. But you might raise money from an angel investor, get the money you need to get your business off the ground, okay? And then you need a little bit more money to get yourself where you're profitable before you can bring a venture capitalist or some kind of debt financing, other kind of long-term loan. And these can work really well in that. So but the bridge financing can work well whether you're trying to get debt financing, you're trying to fill the gap between debt financing or loans or credit lines that have to be paid back to a private individual or lender. And it also works really well in the private equity space when you're selling a piece of your business or giving away a piece of equity in exchange for the money, where you're not taking on debt, you're exchanging equity for the money. In either world, bridge financing is popular and can really help you. So bridge loans are standard in real estate. If a buyer has a lag between the purchase of one property and the sale of another, and they return to a bridge loan, property owners get short-term financing to pay for one property until another property sells. So perfect examples here, right? You have a property, you want to buy another property, but you need to sell this property to get the money down for the longer-term loan on the other. Well, then this kind of financing can bridge that gap and give you the time you need to actually sell the property, so you're able to come in and get the money you need to then move and get the longer term. So we see this common theme with bridge financing. It just bridges this gap so you don't miss the opportunity. And if I really had to sum up bridge loans as easily as I could, that's how I would sum it up, is this bridges the gap between you getting the money you need long-term so you don't miss opportunities. It's a way you can get money now, okay, and pay a little bit higher interest for it because you're getting it so quick. And then you have time, you buy yourself time to focus on getting the other money you need, whether because you bought a business or because you actually are selling a business or because you're buying real estate, many different reasons that we've already talked about. So companies may opt for bridge loans if they've been approved for regular business loan, but in the interim of getting funded. Bridge loans can also be put in play when a corporation is releasing an initial public offering or going IPO. Bridge financing in investment banking terms is financing used by companies before their IPO. So again, very popular in the venture capital space, very popular with angel investors, very popular when you're going for an exit, like filing for an IPO. It's designed to cover expenses associated with the IPO, and it's typically short-term in nature. So this is a perfect example. So right now, with there's a lot of interesting ways that you can come in and actually raise money and go through some kind of public offering, even without going through all the stages of an IPO. We used to really associate IPOs and going public with companies like Facebook, companies like Uber, companies that are gigantic companies, because of a lot of changes in guidelines of your ability to raise funds now for a business, we see a lot of people filing for an IPO or going public without going through all the nightmares that big companies go through. And in that case, it could cost you $50, $60, even $100,000 to get that actually done, where you can then fill all the paperwork out, get the attorneys to do everything, where you can go raise money publicly for anybody that will give you money, right? Your friends, your colleagues, the actual customers in your business, your prospects. Those are where a lot of these companies filing to go public now are actually getting their customers. But you got to have $50,000, $60,000, $100,000 up front. So bridge financing is really perfect for that reason as well. You can use it to kind of bridge that gap as you're actually waiting or to use to pay for the money to actually go public and be able to raise capital there. So one major difference between long-term loans and bridge financing is the speed of financing. You know, loans that take longer term, like SBA loans, conventional commercial real estate loans, conventional real estate loans themselves, you know, being able to go public, being able to get venture capital, almost all of the money we really want to get because the terms are best, it all requires time to close. And you might not have that time. You might need money faster, and this is a lot faster than waiting for any of that kind of money, because banks spend more time checking your background and credit history. Sometimes it takes months. I mean, sometimes SBA loans can take 3 to 6 months. But if you're applying for a loan, a lot of people need that money much sooner, especially if it's to take advantage of opportunities. And bridge financing happens a lot quicker, so it gives you that opportunity. Another difference between this and regular financing that we often talk about is this qualification. You know, it's just way easier to qualify for this kind of money than it is to qualify for longer term financing, because bridge loan lenders understand that the loans they have are providing a gap. They know you need money quick. They know they need to make the process easy. That's like what these loans are for. It's fast, easy money, and that's what the expectation is. And that's why they often will customize solutions just for you. It's why these kind of financing works if you have credit issues. It's why it works in a lot of cases that will prevent you from getting the longer term financing where you can't qualify. Now, sometimes debt to income ratios come into play, but a higher credit score and lower DTI aren't must-haves. So you don't have to have low debt ratios in your business. You don't have to have good credit scores. So again, as I mentioned, this is just a lot easier to qualify for than other kind of financing. Some may want to see a company's forecast or projections of what you're going to do. They want to may see that you can actually afford to pay back the debt. I talk about that all the time. The number one thing that lenders care about is how that you can pay them back. It's the best thing. It's the biggest thing that they have an interest in. It's just your ability to actually pay them back. So if you have a solid history of repaying loans, well, then, you know, you could bring that in documentation. This is also why you build business credit. Again, I just can't stress enough the importance of building business credit, because when you build business credit, then you show that you have a track history of paying your debts without providing documentation. And again, later this week, we are going to talk about trade. How to add trade lines to your own credit report. Okay, how to add, they're called trade references. And this is very important, because even if you don't have credit with anybody that reports, you're able to use trade financing, as I'll teach you this week, to add favorable things to your credit report to create that history of bills that you already have being on your business credit reports, to show other lenders and credit issuers that you have paid those bills as agreed. It's just so important to pay bills that report to the business credit reporting agencies or get them reported, so you get credit for that. Because if you don't get credit for that, it makes any kind of financing you get harder to get. Now, bridge loans, as we talked about, are a little bit more expensive. But again, you know, more than likely you're willing to pay for it because of the solution they provide, the fast, easy money side of things. Creditors assign more risk to these loans because, again, credit requirements are stringent, you know, and they understand that they're there to actually fill the gap. The interest rates vary, but on average, bridge loan interest rates tend to fall about 2% above average interest rates that you're going to pay for normal financing. So not radically different than what you're going to pay for normal financing, but definitely higher. Bridge loan lenders do not apply a penalty for paying it off early. So that's good. They understand that they're just to fill that gap. So you can typically pay it off without any extra fee. And in most mortgage loans, the borrower pays a higher penalty for paying off the loan early. Because again, you have to think about the logic here. Commercial loans, residential real estate, it's 20, 30-year terms because they get their money over time. And then if you pay it off early, then they don't get that money. They're expecting you to pay it over 20, 30 years to get their money. They don't get it. That's why they assign prepayment penalties. There's really not many prepayment penalties with bridge financing because they expect you to pay it off early because they understand that they're just actually filling that gap. So since bridge loans are short-term solutions, companies benefit from them paying them off early. And when they apply for long-term financing, then again, you don't have those fees by actually coming in and getting around those prepayment penalties. Now, these are oftentimes unsecured, hence the loan isn't attached to an asset that you have like equipment, inventory. Some of those kind of financing are available as bridge loans, but equipment financing, inventory financing, that kind of stuff, you don't have to have an asset oftentimes with bridge financing, which means it's unsecured. And that's what unsecured means. Secured is secured by some kind of asset or collateral that the lender can take if you default. Unsecured means there really is no asset the lender can take back if you ever default. So bridge loans, bridge financing, it doesn't really include a lot of asset-based lending. You don't have to pledge an asset for security or collateral. Other things are used. So due to the unsecured structure of this, well, again, then the lender's going to take on more risk and you take on less risk because you have less to lose, because if you default, there's nothing they could take. So again, it really just comes back to them not having anything to take back, and easier for you to qualify because you don't have to have an actual asset to be able to qualify. But recognize that if a business is failing, needs money to pay back a bridge loan, then you may end up selling the business asset anyway. So it's just something to think about. But again, a lot of assets aren't needed to qualify for this kind of financing like you do need for some of the other kind of financing like SBA loans. So you should expect to be asked for a first lien on any encumbered enterprise asset, perhaps even a second lien, and they may request a personal guarantee. They oftentimes will request personal guarantees. It's very common with bridge loans. And what I mean by this is that if they do have any assets that they want to pledge as collateral, they may place a lien on that at a UCC file in your credit report. But again, if not, then you don't have to actually have that lien placed on your actual asset. And again, the guarantee may be in some cases be limited to the amount of financing. So if you ever default, you're personally liable. Very common, especially on any kind of financing where we don't have assets they can take back. Now, bridge loans, by definition, have repayment terms of a few weeks or up to 12 months. Sometimes I see them up to 3 years with real estate. So, but this is pretty common. If I'm buying residential real estate, fix and flip financing, it's 6 months financing. If I'm getting commercial real estate, I'm getting a bridge loan for commercial real estate, it could be up to 3 years. But typically it's about a few weeks up to about 12 months. Another kind of bridge financing is very popular is for the credit line hybrid program. The credit line hybrid, you can get up to $150,000 in credit lines as a startup, 0% financing, no doc. You don't need bank statements, you don't need tax returns, you don't need any of that stuff. And so what's nice about that is that in order to qualify, though, you have to have low inquiries. You have to have low utilization. So oftentimes we see people that can qualify and get 50, 100, 150,000 in credit lines, but they have too much on one credit card or two credit cards. They owe more than they need to get approved. Well, then there's bridge financing that will give them the money they need to pay down their existing credit cards. That raises their score, lowers their utilization, and that gets them higher amount of credit line hybrid credit lines. So that's another form of bridge financing where the lender comes in, they charge you interest, a lot more interest than you'd pay for a normal loan. Okay, they give you the money, you pay down the credit cards. Now you qualify for more money through credit line hybrid, and then you can get more credit lines at 0%. You get the 0% credit lines, you pay off the bridge financing. So many different examples, but that's yet another. Now, business owners must identify in advance, and that kind of financing usually is about 6 months. So business owners must identify in advance the source of repayment and timing, and the source of expected compensation has bears on how a lender views the soundness of the credit system, how fast you can pay it back. Okay, that's going to make a big determination on their willingness and want to be able to loan the money. If they can loan it to you short term and get the money back in 6 months or less, that's really preferred. But again, the longer time you need to pay that money back, the less inclined that they are to want to give it to you and the more interest they're going to typically charge you. So for example, it's most likely that the lender will get a forgivable judgment to a business that could qualify for a straightforward SBA after the execution of the transaction. In this case, the SBA candidate, the source of repayment will not assured as a matter of timing. So again, it just all comes down to timing. That's what it comes down to, is how long you need the money depends on how long you're actually going to get or how much you're going to pay and your likelihood of getting approved. Now, contract to business relying on profit improvements has a more difficult case to make because the lender's evaluation will change accordingly. So if you're going to do things with this financing to make more money and use the additional money you get to pay for the financing, well, that's a tall order because there's no guarantee that you're actually going to be able to come in and be able to actually pay that back. There's no guarantee that what you're going to do is going to be able to include or increase the revenue, even though you think it will. So one of these types are alternatives to bridge loans. Account receivable financing is one of those where you basically, if you have outstanding account receivables, you can collateralize those and use those to actually get money against. And this is a pretty good way to go. A lot of people let their customers pay them on terms, and they never actually do anything or they never do anything with that financing. They never get financing against those account receivables. But it's a great alternative to bridge loans because it's not necessarily a bridge loan. It's not filling the gap, but it kind of is. It's instead of waiting months to get paid from your customers with AR financing, the lender will give you that money in as little as 24 hours, 90% of it. Then the rest of it they get when they collect on the actual invoices. Now, this allows you to do two things. It allows you to charge more money to your customers. That's actually three things. And it allows you to make it more convenient for your customers to pay as well. And you still gives you the ability to still get paid right away. So let me give you an example here. I had lunch last week with one of my really good friends that owns a very successful credit repair business. By very successful, I mean over $10 million a year in sales. That's pretty tough with that industry. I can only think of less than a handful of companies that have reached that threshold in that industry. And how he's got there is that he charges pay per deletion for somebody that deletes an item off the credit report. $125 per bureau per item. So if you have one item on your credit report on all three credit bureaus, then they're basically charging $375 to get that off. But again, the nice thing is you only pay when you actually get everything deleted. So, the customer benefits because, hey, the great news is that you don't have to pay anything until it's actually deleted. Okay. And at the same time, they get most of the more difficult stuff off a consumer credit report that you can get off. The company benefits because he's able to charge upwards of $3,000 or $4,000 for a service that other credit repair companies might only make $400, $500, $600. He's good, so he can do that. But again, a lot of people were not paying. So we went and used AR financing to get that financed. And then what gave him the ability to now charge $3,000, $4,000, he gets all of his money right away from the actual AR lender. The AR lender collects the money from the actual consumer. The consumer gets the benefit of not having to pay up front and working with one of the most expensive and best companies that's out there in the country. And the owner gets the benefit of being able to charge $3,000, $4,000 for the service, get paid right away from the AR lender. So everybody wins in that scenario. The business owner gets their money right away, but the customer can actually pay that AR lender over time, sometimes over 2 or 3 years. So if you're going to let your customers pay you on terms, you're typically not going to give them 2 or 3 years to pay you back. AR financing allows that to happen in some cases. So it's a really good alternative here, okay? So bridge loans may have certain FICO requirements, but with AR financing, you really don't. Like I said, about 90% of your financing can actually be, or 90% of your receivables can be advanced against with AR financing. Now, if you have credit issues, you can be approved with personal credit scores as low as 500 for many types of bridge loans, even if you have recent derogatory items such as collection. And lenders truly just don't care as much about your actual personal credit. Okay, they care more about the credit of the companies that they're actually dealing with when we talk about AR financing. So again, it's a great alternative. Another alternative is merchant cash advances. And merchant cash advances, you're selling your future revenue at a discounted rate. That's how merchant cash advances revenue lending works. So another good alternative here, where it can also be kind of used as a bridge loan. Merchant cash advances are, over 2-3 years, you typically pay it back. It's not the kind of money you're going to invest in long-term low rate financing. But again, it can really bridge the gap where you need money right now. You can get this in as little as 24, 48 hours. You can have very bad credit, even less than 500 FICO scores, and still be able to qualify. But again, this isn't going to be the lowest interest rate long-term financing. It's going to be financed over 3 years. The interest rate is going to be high, but it's still really good alternative to bridge the gap between you getting longer-term financing but needing money to do right now. Now, business revenue financing is very similar to merchant cash advances and can also be used as an alternative to bridge loans. And with business revenue financing, it's the same as merchant cash advances, but merchant cash advances are easier to qualify for. With a merchant cash advance, you'll need to be in business 6 months, have $5,000 a month in revenue. For revenue financing, you typically need a year in business, and you typically need $10,000 a month in financing. So when we look at this, revenue financing, merchant cash advances, if you have good revenue that's consistent, it's steady or it's steadily increasing, these are good alternatives to bridge loans. They're not really bridge loans, but they do bridge the gap between you getting the money you need now and not. And we've jumped on all kinds of opportunities because of these in the past, where we went in and got higher price, lower term money, but we used that money to invest in things that gave us a rate of return. So that then paid more than money than the loan actually cost. So these were great ways to fill the gap for us here at Credit Suite. I think we can do the same for you. We talked about credit line hybrid. It's not really a bridge loan, but it's a great way to bridge the gap between getting the money you need. 0% for up to 18 months. Get it as a startup. You need a 680 FICO score or a guarantor that has it. And it's no doc financing as well. And again, you don't need financials. You don't need bank statements. You don't need tax returns. You don't need any of that stuff. But again, even if you don't have utilization, even if your credit card balances are too high now, you can get a bridge loan to pay down your credit card balances to qualify for this program, to qualify for more money for this program. So it's good for this topic because it shows you how a bridge loan works and how a bridge loan can be used creatively to get you approved for even better financing. And that's why I like bridge loans, is that working with every legitimate kind of funding product like we do at Credit Suite, we're able to use bridge loans to bridge the gap and then get our customers longer term financing that they want. And that's one of the nice things, is using a bridge loan here to qualify for a program like Credit Line Hybrid that you normally wouldn't anyways. You just need to make sure with this program you don't really have a lot of derogatory items. You need to make sure you have less than 6 inquiries, but they really want you to have utilization less than 30 or 40%. If you're higher than that, then you're able to come in here and you're able to pay off the credit card balances you need to then be able to qualify for more money. And that's sometimes what we do. Sometimes our clients will qualify for Credit Line Hybrid, but what we do is we get them a bridge loan to be able to pay off the credit cards and lower the balance, because we can get them way more money if they do that. And we give them the option. Hey, you can get 50 grand right now with your current utilization. You can get this bridge loan, and if you pay off the credit cards, it looks like you can get 110,000. What would you rather do? And they come in and they get a bridge loan to be able to pay off the credit cards and then qualify for considerably more money with the program. So some alternatives to bridge financing as well. So bridge financing, really a cool way to get money to bridge the gap between the money that you need now and the actual long-term financing that you may want. The terms are short, the interest rate's high, but the qualifications are way easier than what you're going to find with other kind of financing. Let's also not forget there's alternatives to bridge financing, which aren't really called bridge loans, but they do bridge the gap. Credit line hybrid bridges the gap. Merchant cash advances, revenue lending, account receivable financing. All these fill a void and fill a gap. And remember, there's even, as we talked about, there's even bridge loans within that as well. We talked about the credit line hybrid and using bridge financing to even pay down your existing credit cards in order to be able to qualify for more money. Okay, so if we can help you along the way, let us know. We never charge you any money to be able to get financing for your business. We'll actually develop a blueprint to get you into an SBA loan and offer all kinds of bridge alternative financings in between based on what you qualify for now and what you want to get. We got to fix this to get you what you want. So we'll come in and get you all the money you can get now, fix the qualifications so you can get the longer term financing. We never charge you a dime. Sometimes lenders pay us a referral fee. Sometimes they don't, but you never pay us any money to be able to help you get funding for your business. We do have a good business credit program that you can enroll with and does cost money, but our funding, we never charge you any money to actually go out and get loans or credit lines. So if we can help you along the way, let us know. If you got value from this, then make sure you go to the top right of our, well, first of all, please like the video and love the video. It's such a simple thing. Just take a moment right now and just like the video. That tells the social platforms this is valuable information, lets them show it to more people. If you haven't subscribed, subscribe on whatever channel you're watching. If you're subscribing on YouTube, click the little bell icon beside the subscribe button and select all so you get notified when our content's live. And then we go live Tuesday, Thursday at 1, Wednesday at 11 o'clock, all Eastern time on Facebook, on YouTube, on Periscope, and on LinkedIn now. And we also have a lot of other daily tips that we have on our podcast, The Business Credit Financing Show. I think we're now releasing an episode every single day of the week on our podcast. And you can find us on Instagram, Facebook, all of that's at the top right of our page, creditsuite.com. More to talk about this week, including how to get trade references out of your credit report to give you more credibility, and including talking about some other cool ways to get business credit financing we'll dive into later this week. Thanks everybody for tuning in. Trayvon, thanks for coming in. Jesse says, I was charged to help. I'm not sure exactly what. Jesse says, I was charged to get help from your company. We never charge you to get any kind of loan. If you buy business credit from us, you'll pay for our actual business finance suite, but you won't pay us any money. So to be clear, and I try to label this, I try to be clear of how this works. Just because you work with us doesn't mean the money you get from a bank is free. Obviously, if you're going to get money from a bank, you're going to pay an interest rate. You're going to pay a fee to that lender. When you work with us, we do a higher volume of funding, so we get you lower rates and fees from the lender. but we never charge any money to help anybody get funding. But the lender will charge you normal interest rates and fees based on your risk. We do negotiate that and help you get down, but just be clear, you will pay them an actual financing. Some cases, and well, in all cases, that's how lenders actually get paid. And Viral says, I have a court, but having a hard time getting funding. Get in touch with us, 877-600-2487, 877-600-2487. We'll talk to you about building business credit. We'll also talk to you about different ways you can get funding for your business based on your unique scenario. Elle says, what if we already applied for an SBA loan and have been approved for our business? Which is better to do? We want to make sure we're doing the right deal here and we haven't closed. If you got approved for SBA, close on the SBA. SBA is the best kind of financing you're going to get for that business. It's longer term, low interest. So if you can get that, my suggestion is to go get that. If you want a second opinion, give us a call. We'll definitely talk to you about it. But we try to graduate people to SBA loans. If you're about ready to close on an SBA loan, then you're in good shape. As long as it's the real SBA loan through an SBA lender, it's probably one of the best kind of financing you can get. Pamela, hey, thanks for the info. Thanks for tuning in. I appreciate it from YouTube. Trevor says, I'm definitely ready to start. Can I just call that number? Yeah, just give us a call. We'll talk to you about our business credit building program. We'll talk about funding as well. Terry from YouTube says, can a corp outside the U.S. use merchant and equipment funding? No, you can't. You got to be a U.S.-based business. And part of that's because of money laundering requirements from the government. They don't even let lenders do a lot of that. The second is just recourse. The lender's not going to want to lend you money when they can't actually come in and when they actually came in and get, and a lender's not actually going to be able to get their money back if you ever default, if they're not outside of the country. If your business is outside of the country, they can't get their money back in case you default. So that's why you're not going to typically do that. If you have a U.S. business and you reside outside of the United States, you can get money. You have to have a U.S. business to typically get it from a U.S. funding source. And Viral says, video says, my Paydex score is 80. Congratulations. Keep building accounts. Remember, the score is not what matters. What matters is how many accounts you have on the business credit reports. So that can help you as well. Jesse, if you want to talk a little bit more, then give us a call. We'll talk to you more about how we can help you. It sounds like get any help with my business side, but on my personal side. And Jesse, that could be, you're saying, hey, I got funding on the personal side, but not on the business side. And that's all based on consumer credit quality. It's that simple. So with Credit Line Hybrid, you can get standard cards, which are personal reporting cards, and you can get business cards. The difference is the business cards require really good credit. You need 700 plus FICO scores to get the cards that report to the business reporting agencies. You can get the consumer cards as low as 650 scores. So usually if somebody can't get the business cards, it's because you have credit issues. Your utilization is too high. You have too many inquiries. You don't have enough established revolving accounts. You've got damage on your personal credit reports. Any of those things can affect that. If you want to talk more, feel free to give us a ring. D'Angelo says, how's Credit Suite handling new fintech like Plaid? How does Credit Suite adapt to new changes in the landscape? With us, we have a whole data team that's always constantly on the hunt for new business credit sources and funding sources. And all they do is go out into the marketplace and look for new sources that come in. And then we find them and add those to our platform. But again, if you ever have any suggestions, then let us know, because we do a pretty good job of researching the space and adding any to our arsenal that aren't already doing things. We have hundreds of businesses pouring into revenue lending or merchant cash advance spaces. We don't really care about that unless they do something everybody else doesn't do or don't offer better terms. But we have a data team that keeps up with that, just so you know. And Al says, can we still get your company to help obtain further funding if we need more? Absolutely. Yeah, we can definitely help you with that. And if you want a second opinion on your SBA loan, give us a call as well. So thanks everybody for tuning in. If we can help you with getting business credit financing for your business, give us a ring, 877-600-2487. Don't forget to like and subscribe. And we'll talk to you more this week about cool ways to get money for your business. Thanks everybody. Have a great